Folks, we wanted to let you know how much we appreciate you tuning in. And we wanted to let you know all the resources that are available to you. We want you to look through 2024, see what we've been able to accomplish together in the past, in the present right now, and looking towards the future. Go ahead and check out the reel. You're going to love it.
It's been a great year. We thank you all for being with us along for the ride. And this highlight reel, like Chuck was just saying, just some highlights of some of the things we've gone over. And we look forward, of course, to a lot more stuff to come. So check it out.
CD Financial, where health meets wealth.
What would you say is some of the first steps as far as getting pylons down so I can have a stable foundation for the future?
Is make sure that your money's not in fluctuation for the money that you need for income. So you want to separate that retirement savings that you need for income and separate that money that you need for growth, perhaps thinking of that as money in the stock market. And never shall the two meet. In other words, if they're commingled in one bucket, then they could really be a problem.
Yep, simple and straightforward. Again, I'm a big believer. You don't have to have a lot of ingredients to make a good meal, but you have to have quality ingredients. You have to start out with good stuff. You can't finish with a good product if you don't start with good materials. And that to me is the key, always. Either one, widow or widowers. So how long do you have to be married to someone before that actually applies?
We're talking about 10 years that you have to be married to somebody in order to file for a widow's benefit. Now I'm hearing you correctly. I'm slowing it down.
Yes, that's the question.
Yeah. You have to be married for exactly 10 years or longer. So the date of marriage and the date of divorce has to be 10 years or longer.
Why is there so much talk about a Roth?
Question number one, let's handle it. Because the Roth is so awesome. The Roth grows tax-free. So when the money goes in there, guess what? One and done. You've already paid taxes on it, but never again will you have to pay taxes on that money.
Yes, we have something we say in Texas when it starts to get hot. It's hot. That's what we say. There's nothing you can do about it, man. You just got to take cool showers and stay in the AC. Yeah, so that you're basically going from having that security blanket of my job, right? I get in over my head. I know I go back to work. I get another paycheck. But now we're starting to be concerned with not having enough, right? Or at least not being sure you have enough. I guess that would be the real concern.
Yeah, yep. It's I'm going to illustrate it this way. It's like heading out on a camping trip. Do you know what dry camping is, Marcus?
No, I think camping should be done at the Marriott almost exclusively with a nice breakfast buffet. I'm not a huge camping guy.
A little bit of water, and you clean everything you can with as little as you're going to use. Forget about taking a shower. We're in that campground for 5 nights. You are not going to waste your water. And you have a meter on the RV. I rented an RV from a fella here in North Orange County. You have meters and you can check your water and your sewer and even your power levels because it's dry camping. There's nothing to plug into. There's no water hookup. There's no power hookup. There's no place to dump. Once you're out of water, you can't even flush the toilet inside. Imagine just 5 nights watching those levels sink down. Now imagine doing that same thing for your retirement for the next 25 to 30 years.
So
that
what
would
we're
be
saying here is that essentially it's an issue of not having enough, right? I mean, in camping, you have so much water and electricity and that's it.
Yeah, because if you did that for your retirement, it would be exhausting.
Point number 6 is debt. Paying off any remaining debt, including mortgages, credit cards, or loans. Why do we need to have that in mind?
Bad debt is bad debt. I know some folks that got 0% on a credit card and they got in a jam where they had to, replace their appliances and, they had a leak in their slab and they're fighting with the insurance company. I get that, right? But there is some lingering debt And here's the funny thing that you wouldn't even expect. I've met folks that have 1.3, 1.1 in their retirement savings account, and yet they still have some lingering debt. They don't believe in keeping money just away at the bank. And so they've got $5,000 or $10,000 in their savings account, and they got piles of money in their retirement savings. And so for those of you who have that, I would suggest eliminating the debt. If you've got credit card debt, or you've got automobile loans that might have a really high interest rate, like 8, 9, 10%. There might be some of you that have a student loan debt. Get rid of that debt, okay? Now, we're not talking about mortgage debt. And do you know why we're not talking about that, Marcus?
No, because that seems like it would be a debt just like everything else.
Yeah, because for a lot of us, we've got a mortgage that's around the 3% mark. And if it's below that, wow. If it's above that, just a little bit, wow. It's still, that's what's called money being cheap. So we're not talking about a mortgage, but we're talking about the other debt. We're talking about anything where the banksters are making all kinds of money on your back, then you'll want to get rid of that debt. I don't know if you knew this or not, but if you just got started on a 30-year loan, even when your interest rate is really low, mortgages have a lot of upfront interest on the first 15 years. I was surprised to see that myself. I remember my first home we owned. Oh, I was so grateful to have a 5.5% loan interest rate. But after 7 years of paying on that loan and selling it, wow, we hardly gained anything on the principal. So sometimes if you are refinancing, you might want to consider a 15-year loan. That might be good. A lot of folks that are selling homes and relocating, when it comes to debt, you might want to consider that shorter term loan, because a lot of your payments, you'll be gaining immediate principal and not so all fluffed up with interest like 80 and 85%. But you'll have a really strong payment towards the principal on a 15-year loan right out of the gate. Asset allocation. You spread your investments across different asset classes, stocks, alternative investments like fixed indexed annuities, and cash alternatives. Maybe when we're talking about stocks, we could be using a funnel to get individual stocks that we purchase in your portfolio, or you could be using ETFs, occasionally even mutual funds. This helps balance risk and potential returns. And also, there's a geographical diversification. Sometimes the S&P has got so much love that it might be time now to look outside. When there's when you say global fund, it may not exclude the US, but it might also include Canada, Europe, and other markets, Japan, and developing markets, maybe even emerging markets like Brazil and India and China. So sometimes having a geographic approach, investing in the broad market, you can reduce dependency on any single economy. Right now, since that S&P in the US has seen so much returns for so many years, feeling is that maybe international stocks could be overlooked, maybe even smaller stocks instead of the S&P 500 or the Magnificent Seven that you've heard mentioned. It could be that there's opportunities elsewhere.
So the first thing I have to do, because I think a lot of people probably like me don't understand it completely, what is it? What is FERS phase retirement?
So I was taught in, well over 15 years ago, that when something sounds complex, especially in the financial arena, just change the order of the words.
Okay.
FERS is the Federal Employee Retirement System. So we're talking to FERS employees. FERS retirement phased. So there's going to be phases of retiring. And guess what?
What's that?
A lot of federal employees and a lot of folks in general would much rather retire
in phases.
I should think about this because if I die while I'm employed, there's a difference. Again, in my head, I'm always thinking end of life. I've done everything I could and I'm done.
Absolutely. There is a benefit that is not often understood well at all that exists in addition to your federal employees group life insurance, your FEGLI. Yeah. And look, folks, everybody has their basic group life insurance. Well, everybody does unless you, when hired, fussed about it and said, I don't want that basic group life insurance. But I think even if you're single, you ought to have the basic group life insurance. If you don't think there's any loved ones that really need to get a death benefit, but have something there that's tax-free when you pass away so they can bury you in a decent manner, right? And maybe your estate can settle it out smoothly because you just happen to have the basic group life insurance. And when retiring, we talked about it too, you do that. If you did, which most federal employees when they retire do this, they do a 75% reduction and they get rid of 75%, but they keep 25% of their life insurance, basic.
Right.
And that the estate has some kind of life insurance, even if it's a modest amount. And why is that important? Again, the basic, because the government in your benefits package pays 1/3 of the premium in your basic group life insurance. You only cover 2/3 of that premium. Oh, and by the way, your FEGLI group life insurance is paid 1/3 by the federal government. It's part of your FERS benefits package. So why not, right? You only have to pay 2/3 of the premium. So why not let the government give you their benefit by paying 1/3 of the premium?
Yeah.
That's it. We're talking about a geoarbitrage or relocating to another area to save money for retirement and to ease things. We've got a perfect example with Rock. And Marcus, why don't you take it away and ask him a couple questions?
But now, no longer in Southern Cal. You have moved somewhere else.
Yes.
We've been discussing the topic of geo-arbitrage, finding someplace a little bit better financially advantageous, let's say, right, for retirement. Where are you currently? And you don't have to give a specific address. Right?
Arizona. Kingman.
Arizona. Fantastic. And how is it right now in Arizona?
It's warm, on the higher side of warm.
that is probably the.
We're only like 95 today.
Oh man, that's downright chilly. I think in Arizona. Yeah, warm is. Yeah, I think there's a very nice way to describe the Arizona heat. Well, good. You look great. Now you seem to be doing well with it. So getting into the topic. I think, and we've kind of alluded to this as we've gone through this discussion and bringing you on, we've alluded to it. But what was it that compelled you? What was the impetus for you deciding, love Southern Cal, but I need to find a different place to be and heading out to Arizona?
The weather, it wasn't worth the weather anymore. Everything in California, it was the weather's great on that. But all the other stuff, just couldn't compensate for the weather. So we moved somewhere else.
All right, fair. That's fair, and I think that's that's where we're at on our topic today, and that's good to hear. There comes a time when we have to weigh things out. So, how has your overall experience been? The move, living in a new spot. What has it been for you, or how has it been for you?
Oh, actually, overall, it's been really great. We've met some really super nice people out here. It's not really a small town anymore on that. It's only about it's about 3 hours from Phoenix and an hour and a half from Vegas. So we get to go play. Riverside, Laughlin's only like 45 minutes. So we look for a place that will put it close to where we can see family and stuff like that, and a base to where we can make travels on that, so that that puts us in a good position of where we want to go and stuff. It's easier to start from here than it is from a place like California or Phoenix, or so we're pretty well situated.
Hey Rock, what's been the overall effect on the cost of living?
Well, our cost of living I've looked at that, and different areas. Some are pretty close, but otherwise there's some drastic changes on that. You can buy tags anywhere from a year to 5 years on that, which is for about the same amount that you pay for a year in California.
So when he's talking about tags, folks, he's talking about registering your car. I'll tell you that because I'm still in California, in Southern California, and enjoying this beautiful weather, I also pay $600 a year for each of our 4 cars just to keep them registered. Some of you hear that and you go, what? Yeah, so Rock's pointing out that in 5 years, you can register a car for about the same cost. About that.
Well, less than that. Our insurance, when we moved here, we got it for 5 years on our Cadillac, and it was $115 on that.
Oh, for your registration, you mean, Rock?
The registration was for 5 years, $115
Wow.
on that.
Man, that's cheap.
23, we renewed all our license, all our vehicles, and we had like 5 vehicles when we did that. And all 5 vehicles for about a 2-year span was $216.
Hey, Rock, tell me about when you sold your house, what you sold it for, and when you bought the house in Kingman, how much you paid for it.
Well, we sold our house in California for about $575, and then we paid $180 for the house. $180. Yeah, $180 for it's a. We stepped down by 100 feet, so we're at 1442 instead of 1542.
Do you miss that 100 feet, Rock?
Huh? Yeah, we miss it, guys. But we got an extra garage to make up for it.
I'd say that's a fair trade.
Yeah. So.
Yeah, so that was a huge price swing. When was that, Rock, when you bought the house in Arizona? What year was that? What year was that, Rock, when you bought the house in Arizona?
We had it built.
Oh, you had it built. And when did they finish building?
December of 17.
Okay, yeah. So we're talking about a big swing. Man, time flies, doesn't it?
Yeah.
Wow, I can't believe it's been that long, Rock. That's crazy. Wow, I can't believe it's been that fast. Yeah. Yeah, it was pre-COVID, but still, you sold your house for, well, what, 2.5 times? Almost 3 times as much as the house cost in Arizona? Yeah.
Oh, yeah.
Yeah. Yeah, and I could tell you all that just by visiting with Rock and Brenda over the years, it's been a very easy transition, and they're really surprised, even shocked at how little they spend per month in retirement in a very low cost state. Of course, Arizona still has a state income tax, but it's a smidge. It really is. Yeah, it's really small. It really is. And of course, they don't tax Social Security. So if a lot of your income in retirement, Social Security, then you're in a really low tax bracket anyway, and federally as well. So,
what would you suggest to someone who's looking for a good place to land? I mean, what was your process for finding your spot?
Well, we kind of decided on places we think we would like, and then we would visit those places at least 3 times a year in different seasons on that, because you might go there and it's like the greatest thing in the world until you find out winter gets there and they close the town down. You know, so which on our trips we ran into those kind of cities, and they're beautiful, but you know, you sit in your house. So we've looked to see, as I said earlier, we were looking for a place that we felt we could travel to wherever we wanted to go without any real problem at all on that. And that's why we picked this. And plus because it's 10 to 15 degrees cooler than Vegas or Phoenix, which really made a help. Even though it's warm out here on that, it's nowhere near like back there. And our cost is on a lot of different things. It's tough to tell, you know. So when you're looking, if you look at all the utilities and all those things like that, you can get an idea of it. We didn't find out exactly what the cost would be on some of those things until you actually get here, because they change so fast on that. But, you know, we still found that it's still, you know, finding a place besides outside of California finding a place isn't that hard. You just want to find a place that you're, that you really saw that you could, you could see that you could live there. We'd come out and visit, and wherever we go, we'd go to meet people to find out if these people are a lot of fun, and we found that they are. So that was another deciding factor.
Well, the question is, getting back to what we're talking about, going back to retirement, because you always emphasize there's one thing that's essential for retirement. What is that?
You got to have a written retirement income plan. You have to have the plan. It's got to be down in writing. It's got to be very clear.
Very, very good. So what is it that makes that up? What's going to make up that written retirement plan?
The essential elements. So don't let the wording scare you. Just change the order of words sometimes. A income plan that's written down. So what are your income needs? So you got to figure out, or you have the help of your advisor. We do this all the time. We help federal families and those even that aren't federal figure out how much they need to live on. Oftentimes we use the net take-home pay from your pay stubs, and we figure out if you're saving money or spending beyond that. And then we come up with the answers to how much you're living on. So you need to know how much you cost in retirement. And then secondly, what are your sources of income? How much is your Social Security? Do you have a Social Security maximization plan? It's actually a third piece. How much is your FERS federal pension? Are you working with somebody who knows how to calculate those pensions, knows how to work in the survivor benefit to figure out what your gross is, but what is your net? If you have VA disability, how much is that? Do you have other pensions? Do you have a military pension? Do you have pensions from other providers? Or, Boeing, or et cetera, et cetera. Add those all up. That should be in writing, in software that we use. And then, so I don't forget anything, assets for income and assets for growth. Never should those two meet. The assets for income should be insulated from stock market loss so that when you pull on that money for income, it's not a sinking asset because of stock market losses. And then you've got the assets for growth. Always a great idea. Stocks and other things, but they don't need to be for income. So when they go down, you're not hurting them by pulling on them. So you need that as well. And then my favorite is an effective tax plan. So rare that anybody ever has a tax plan. It's so rare. I've met folks 8 and 10 years later that said they were going to implement their own tax plan. They didn't do one thing with it because they don't have somebody moving them forward, motivating them forward constantly, 1, 2, several times a year to encourage you to go forward with this. And I've seen the numbers. A family easily in a 20-year retirement can save tens of thousands of dollars or more if they get in there. But it's a little stings along the way. We liken it to taking a Band-Aid off slowly, or where the hair's sticking to it, or just that's it, Marcus. Just yank it off. It hurts, but sure are glad when it's done. So it takes effort, and there's a little pain along the way, but no pain, no gain, folks. It's just like when you go to the gym after you haven't worked out for a while. It sure hurts the next day, especially 2 days later. But boy, oh boy, you start looking good after about a month and a half, don't you?
Yep.
Same,
you feel good.
Yeah, same thing with a tax plan, Marcus. You got to have that. And even a long-term care plan, you ought to address that. Whether or not you're going to implement it or not is your business. But you really should address all these things. And a lot of times, an advisor may just be really good at growing your assets up to the point as you're nearing retirement, but may not have the toolbox that he needs or she needs in retirement for you.
We've kind of kept our focus on a marriage situation, right? Somebody that's married, but obviously not everybody's married, but they still want to make sure their beneficiaries, whoever they choose, are benefited, right? They want to make sure that they're taken care of. So what are some of the forms that they need to pay attention to, and some of the things that they need to focus on?
Okay, so if we're talking federal families,
Right.
and we're talking federal families, you've got a number of things. You've got your TSP, you've got your Federal Employees Group Life Insurance, FEGLI, you've got your FERS contributions. So if you're not married, I'm going to explain that to you too. If you're not married, then there is nobody that's going to get a survivor benefit pension. But all that money you put into your pension, there's going to be a lump sum. A lot of you in your top right of your pay stub, the Leave and Earnings, LES, it'll say cumulative. Might be box 19. It says cumulative FERS, cumulative, it says, Federal Employees Retirement System. Or the old system, CSRS, if some of you are listening as well. If you pass away and you're not married, nobody's getting the pension unless there's a divorce decree. Then there is no pension, right?
Yep.
But that means those who are working. We're not talking about if you're retired. If you're retired and you pass away, then nobody else gets your pension if you're not married or there's not a divorce decree. But while working, if you're not married, there is that lump sum that your other beneficiaries can inherit.
Right.
Yeah, I had somebody I worked with that she kept her couple option Bs from her group life insurance that were very expensive.
Yeah.
And she was over the age of 60, but she didn't tell me why. Apparently, she had a condition that was way worse than she had indicated to me.
Man.
And so her son got that lump sum benefit. Yeah. So that's one of the benefits that he got. Right behind him at the top of the wheel, there's income planning. Then there's investment planning. I'm pointing to that banner behind him. And on the bottom, there's tax planning. And then there's, healthcare planning and legacy planning.
Okay.
So what happens when you go to the fine dining experience and you cooperate fully is that everything with your TSP and everything else in your life, not excluding the TSP, but or anything else, your Social Security planning, your income planning, your investments that match your goals, the tax planning. This really stood out to me because what happened was, Mark, a decade later, the Smiths came back to me. Finally. Now, I would point out that we used to reach out. We reach out to everybody at least once a year.
Right.
Sometimes those that have a fine dining experience, oftentimes twice a year we meet. But once a year we reached out to the Smiths and they didn't respond. And so Jude asked me, team member, my second born son, runs the calendar right now as we record. And he says, well, what do we do? After several years of this, I said, well, let's keep reaching out. How about every 18 months? And then it became every 2 years. Do you want to know what happened?
So yes, I was waiting for a break because I did want to know. So what happened? Because you're talking about this whole selection of things behind me, right on the banner. You want people to think about all these things for their sake. It's not just you're not just selling things. You're setting people up for success.
Absolutely,
and
we're fiduciaries.
Right, and that's the idea that we want to make sure that people understand. It's not just about let's get you another product or service. This is about setting yourself up for success. So what happened?
It's about going deep, Marcus.
Absolutely.
Right? They talk about going 1 foot down and 10 feet out.
Yep.
We go 10 feet down and 1 foot out. We go deep.
All right.
Before we ever start to go out at all. We want to plan.
Is interest rates. And a lot of times the same thing happens. People hear the Fed either raises or lowers interest rates, and then they're already having some anxiety as to what that means to them, right? How is this going to affect me?
Yeah.
So recently Fed lowered interest rates, right?
Right.
That's what we're looking at now.
That's right. And what was the effect?
So that's my question to you. So what is the effect? Because I think a lot of people are going to think, well, what does this mean for my TSP? What does this mean for my 401k? What does this mean for my IRAs?
Yes.
And we're already feeling that anxiety because we're just looking at that interest rate lowering.
Yes. Okay. So, we do know when the Federal Reserve raised interest rates to control inflation because the economy was too hot and they kept interest rates too low for too long. And they really did. So we had that effect in 2022. They jacked up interest rates and kept them there through 2023. And what happened when interest rates rise, stock market reacted and it lost, what was it? When we say it lost, I think we're talking the S&P lost 18%.
Right.
Now that's the C fund at TSP. Or if you, at your 401k, you have an S&P 500 fund. I think it lost about 18%. But the rest of the stock market, at TSP, that's called the S fund, like small.
That's fun.
That lost 26%
Oh.
when the Fed raised those interest rates. But when the Fed raises interest rates, what else happens is bond funds suffer. So the F, or fixed franc fund, the fixed fund, it also lost. In fact, in 2022, if you look at the TSP fund performance, I want to say, where is that now, Mark? It lost almost 13%,
Wow.
minus 12.83. Yeah. So when interest rates rise, bonds typically suffer. We'll talk about what happens now, and we'll use an illustration as we go.
Okay.
But now that interest rates, and look, I think you know it. You could get really good interest rates at CDs and really high interest rates on a mortgage.
Yeah.
Right? So everybody kind of, are you still there, folks? You're just staying.
Yeah.
You don't want to leave because you got a 30-year mortgage at 2.5%.
You know, we're calculating costs because as we get to the retirement age and we have our plan in place, we have everything set up, but we want to make sure it's realistic, right? Because part of it is just looking at numbers on a page and everything can look good, but if you don't know what you really cost, then you might end up with a little bit of issues, right? After you,
Okay.
with some issues. So how do I figure out how much do I cost?
First, before we
Yes.
go into the how,
How?
why don't we read a principle
Please.
found in an ancient book,
Okay.
an ancient holy book, some would say, many would say.
Yeah.
It's from the Gospel Luke, chapter 14.
All right.
And I just thought it was very appropriate for this conversation. Luke 14, 28 and 29, it says, for example, who of you wanting to build a tower does not first sit down and calculate the expense to see if he has enough to complete it? Otherwise, he might lay its foundation, but not be able to finish it, and all the onlookers would start to ridicule him.
Yeah.
So who's going to build a house here, in this case a tower, and not first calculate how much is it going to cost me, and can I get past the foundation and build the entire house? Otherwise, I look like a fool, right?
Right.
So who's going to go and retire unless they absolutely are sure that they can afford to retire?
Exactly.
You've got to do that.
So the tower of retirement, if we're going to use that analogy, tower of retirement, we want to make sure that we make it through, right, as long as we can, that we're not just surviving, because we're not just talking about surviving.
No, we're not. It's no fun just surviving.
We want quality of life.
Yeah.
We want to enjoy those years. So that's the tower we want to build. But we have to be realistic, because I think what happens sometimes as we plan for retirement, we're looking at it from over here and we're saying, okay, I'm setting aside X. That sounds like a great number, right? Here it is. This is what I'm setting aside. But then when I get to that point and I retire, now all of a sudden I find out I cost Y and X is not quite covering my Y.
That's it. Yeah,
and that's
absolutely. And so there's sometimes why people say, well, I thought I could retire at 60, but I think after talking with you, I might want to, Charles, I think I might want to go to 63 or 65.
Yeah.
And we can take the makings of the CRC, that charted retirement course, the written retirement income plan, and we can copy and create new, and we can make another scenario and say, well, let's see when you run out of money at 65 instead of you retiring at 60. Let's see how it looks at 62 instead of you retiring at 60, and see if it's more successful.
right.
And it gives you a lot of leeway. Depending on who wins in the election, fiscal policy,
All right.
right? Fiscal policies can start to cause market fluctuations, and they're looking for a defining of the fiscal policies.
So let me just for the sake of understanding what we're talking about, when we refer to fiscal policy, that's the use of the government revenue, whether it's whatever type of collection or taxation that they're using, right? And then the expenditure and how that's used to influence a country's economy. That's what we're referring to as fiscal policy.
Okay, taxation revenue. Yes, that's right. I'm glancing down because I want to get it right too, right? That's it. And the regulations thereof too inside of the fiscal policy, right? Taxation, government spending regulations. All three of those can impact economic growth and also stock market performance. Yeah. Taxes, look, if a lot of corporate taxes are implemented by whatever administration gets in, that can affect corporate profits, and thereby it could affect the stock market, maybe in an adverse way. So then it could affect your TSP's performance, could affect your 401k, IRA performance.
So all those things, I mean, again, going back to the topic of uncertainty, that's why people start to kind of,
Yeah, they get anxious. They don't know what's coming, right? They got 3.5 years with one candidate administration, and now it's going to change. What's going to happen, right?
Yeah, we know for a fact this year there will be a change because it's already been announced, right? There's not a re-election, or he's not running for re-election, the sitting president. So we know there's a change coming. So
there you go.
Might even add to the anxiety people feel.
Yeah, and then you've got government spending, right?
Right.
If they actually, this isn't something to take note of. If the government actually works on infrastructure, they're actually spending. They're building up whatever they're building up, right? What was it? Internet and I don't know, renewable energy.
We always say roads and things like that.
Roads,
we
yes.
That is infrastructure.
Yeah, I mean, maybe we need some infrastructure on the sewer lines and other things, right? Utilities, public works.
Yep.
But if they spend money on the infrastructure, then it creates jobs.
Right.
So that could be a good thing.
Right.
Again, though, if you're spending money, you're going to have to support it somehow. It would be, instead of devaluing the dollar by turning on the printing presses, they might have to increase taxes. And we know that present tax brackets are historically very high or very low, Mark. Do you remember?
I think they're very high.
And in fact, they're very low.
Very low.
And most people would agree with you. They would say, I think they're really high. They're not. Historically, taxes are really low. Yep. And so because they're really low, in the distant, not too distant future, I should say in the not too distant future, we're supposed to sunset and revert back to the old higher tax brackets. Yeah, so government spending could help the economy. You've also got a regulatory risk, right? Because if there's cuts or there's more regulations, it could hamper the market growth. We're going to consider one of the 5 major TSP funds today. How's that sound? We'll see if we can put a podcast together about the subject. And which fund would you like to talk about?
Well, I know an all-time favorite of yours, Charles, has been the I-Fund. So let's dig into the I-Fund.
Okay. And do you want to tell them why this is an all-time favorite?
Well, I said that a little facetiously because when we consider the long-term returns of that I-Fund, we're really taking the most risk in that I-Fund. On the spectrum of risk from G, F, C, S, the I has the most risk. And so if I'm willing to take the most risk, what do I also think I'll get?
Okay.
The most return.
Yeah, that's right.
Risk.
You think, but if we look back historically on the figures with the I-Fund, it's and folks, it's everything outside of the U.S., so it's not domestic stock fund like the C or the S fund. Charlie and Sam. I always say Charlie here, Charles, Chuck D, and Uncle Sam, they got your back, right? So that's how you remember the TSP funds for growth. But the I fund has always been around, but it's paled in comparison. Is that the expression? Yeah, it pales in comparison to the C and the S fund. And so they've been doing some things with the I fund. Ann, why don't you tell us about that? What's been done?
Being the TSP board, there's a governing body over the thrift savings plan that can make changes and regulations, sometimes with the approval of Congress, and some things they have the ability to do on their own. But the index that determines your return on the I-Fund has been changed. And that is a critical factor if you're going to look at the I-Fund in the future.
It sure is. Because as you've told me, and I'm going to go back in 4 and 5 years ago, you said the problem with the I-Fund is they do not include emerging markets. And by excluding emerging markets, they're focused almost exclusively on established markets with companies that have been around for decades that may not have much growth. And when you're thinking about your stock funds in the TSP, the CS and I-Fund, you're typically wanting growth because you're taking risk. And how are you going to get growth when you're dealing with companies possibly that just don't have much growth potential? How's that?
That was a great
You
explanation.
might want to compare the prices. He said it might be a real eye-opener. So you might, right? You might want to do that during open season if you're looking for cost, right? Or even coverage. And when somebody's thinking about changing their healthcare provider and they see the cost is a lot less, and let's say they use their plan quite a bit, what steps can they take to make sure that their coverage is gonna do what it was before, or at least hopefully do what it was before?
Well, there are a couple of good comparison tools out there that will, without you having to do a lot of research, give you a comparison side by side of what you pay for copays in and out of network, what you pay for specialists, what you pay for hospitalization. And here, let me just interject that when you're looking at a plan for hospitalization, you want a plan that pays a flat dollar amount, not a percentage, because those costs in the hospital can run fairly high. And if you're on the hook for even 20% of that, it could leave you with a much higher out of pocket than if you simply know what they're paying per day and the hospital has to accept that. So that's one key about what you could look at. The other thing, OPM offers a comparison tool online. If under their health insurance, they have a comparison tool where you can compare plans. It's a little clunky, if you will. It's about 17 columns in an Excel spreadsheet. But you could also go to a website called guidetohealthplans.org. And it's going to have a subscription fee. Your agency may pay for it, but it's about $16. And if you use a special code that we can give you, GUIDE20, G-U-I-D-E, GUIDE20, you can take 20% off that. And their comparisons are excellent. Make it really easy for you to compare apples to apples.
Guidetohealthplans.org.
Yes.
Okay, and that's for federal employees.
Yes, and they've loaded every single federal health plan, not just the national plans, every federal health plan across the country, over 250 outlines of coverage they've entered into their web-based system.
Why is Medicare such a complicated and complex subject for federal employees? Because compared to the average American retiree, it's not so complicated. But why does it get complex with the federal employee?
Well, if I don't have access to federal employee health benefits, and I'm that average American who turned 65, I've already retired, I'm going to take Part A, I'm going to take Part B, and I'm going to go buy a supplement because Medicare does not pay for everything. And so I want an additional plan or coverage to help pay for the things that Medicare doesn't pay for. For the federal employee, the confusion starts because they are part of the only group health coverage in the country that allows them to opt out of Medicare. They do not have to take it in order to keep their federal employee health benefits intact. So right off the bat, they have to make a decision. They have to decide, am I going to pair my FEHB with Medicare Part B, or am I going to simply stay with FEHB?
So if it's money, Mark, that's what this is.
Okay.
This is about money. That you've put time in active duty military, and since you've put in those years, if you're not retired military, you didn't do your 20 years, you can actually get paid for those years if you're a federal employee now, civilian, at any federal agency. You can get paid for those years that you put in active duty.
Okay. So how am I going to do that? Because if, okay, I've served in the military, let's say 4 years, just to use a number, right?
Sure.
4 years. I go get a job at the IRS. I'm working at the IRS, but I don't want to lose that time. I mean, it's about getting credit too. It's not just about money, but if you've served in the military, you've done a job for all those years. I mean, it is work, so you want credit for that.
Yeah, that's right. And folks, he says IRS because he was in Austin. There's a big center there, and his mom, did mom work for Department of Treasury too? So there it is. Yeah. So if you've done your, let's say in your example, you said 4 years of military service, active duty again.
Active duty.
I'm going to keep repeating that because, you have reservists that can also buy back their military time, and we'll talk about that too. But it's the active duty time that you get credit for. So let's say you get, well, for instance, Mark, let's say you got 16 years of federal service. You're 59 and a half. Let's say you got 15 and a half years of civilian service.
Okay.
And you're 59 and a half. And you got 15 and a half. We're doing the halves.
Okay.
6 months later, you'd have 16 years. And you'll be how old?
You'll be hitting 60 at that.
60. 60 years old with 16 years of federal service, can you retire penalty free?
Not at that point, I don't think.
No, you can't. No, you got to go to 62 with 18.
Right.
But if you had what you mentioned, your 4 years of active duty,
Right.
if you bought those 4 years back, you'd have 16 plus 4, you'd have 20 years of federal service. Excuse me. Plus age 60, 16, 20, you can actually retire now.
So at that point, I get credit for those 4 years. I'm not losing that. I get credit for it now if I want to retire early. That's an option for me. I don't have to wait till the 62.
That's right.
Okay.
Yeah, you can retire now. So it works towards eligibility. That means you qualify to retire penalty free. So an unpenalized annuity or pension. So 60 with 20 years of service. Plus, so number one, you're eligible.
Okay.
But number two, you get paid. It's about money.
Yeah.
You get paid for those 4 years of service. So survivor benefit for your survivor, you got three options: 0, 25, or 50%. 0 costs you nothing, but your spouse is going to get nothing. 25% benefit costs you 5%. So it will reduce your pension. Let's say you've got a $3,000 pension. It's going to reduce your pension by $150. So your net immediately is $2,850.
Still not bad. I mean,
Before taxes and the cost of health insurance, maybe your basic group life till you're 65 typically. Or you elect a 50% survivor benefit, which will reduce your pension by 10%. So they're exactly double, right? They follow the exact track. So 5% of reduction in your pension gets you 25% for your spouse, and 10% reduction in your pension gets you 50%.
Okay.
Yeah.
Then ultimately what it comes down to is what you want for your spouse and comfort of life, right? We're talking about quality of life. We discuss that all the time. Maybe what are some of the things that you would weigh out with
Good
somebody?
question. Yeah. And let me say that just for simple math again, if you got a $3,000 pension in that illustration, then a 10% reduction, you'll now have $2,700 net. But if you passed away, they would get $1,500 per month. If you gave them 25%, if you passed away, they'd only get $750, half as much. One of the considerations, Mark, since you brought it up, is that in order for your spouse to keep your health insurance, because most spouses are covered under the federal health insurance,
right?
Because it continues into retirement just as when you were working. And so it's rare that somebody else in another pension, your spouse, will have a health insurance that works as effectively. Sometimes, but it's really rare. I've only seen it several times.
It's getting rarer.
16 years.
Yeah.
I've been doing this, serving thousands of people with advice, and just a couple times where I've seen that they were not covered under the federal health insurance. Yeah, it's a big benefit, especially into retirement, as I said. So you have to have at least the minimum survivor benefit
Right.
for your husband or wife to keep the federal employee health benefit, the FEHB, if you're gone, if you're dead. So again, you have to get at least the minimum, which is 25%.
Right.
Which will reduce your pension by 5%.
In my mind, if you inherit an IRA, then it should be yours, and now I can make contributions to my IRA. Is that necessarily correct?
No, it is not.
Okay.
Because it's an inherited IRA, it's following the guidelines it's following the guidelines of the person who originally opened that IRA account up. So let me give you an example.
Please.
We've got a client who passed away. Let's call him Jack, okay? Mm-hmm. Jack passed away, and Jane was actually several years older than Jack. So this is different now because we're going to touch on spousal. When spouses inherit an IRA, they have two choices. They can keep it in their spouse's birth schedule.
Okay.
And why would Jane want to do that? If Jack was, let's say Jack was 65 and Jane's 3.5 years older. She's 69.5, okay?
Okay.
Let's say supposedly, okay? I'm sorry. He was...
So if she's 3.5, 68.5.
68.5.
Yeah.
She might want to keep it as an inherited IRA because it will be based on his birth schedule. And so she'll have more time to plan for that money before she's forced to start removing it under the required minimum distribution schedule, RMD.
Okay.
It'll be based on his birth schedule, not hers. However, I'd point this out. Most spouses, when they inherit IRAs, they have the option to just roll it over to their own IRA.
Okay.
So spouses only have that spousal privilege that it can become an inherited IRA, and then they can roll it over to their own IRA.
All right.
And then if they're still working, like you mentioned, or we didn't say they're still working,
Yeah.
but then they could contribute to their IRA if they're still working.
Right.
If you're retired, you can no longer contribute to an IRA.
Correct.
No more than you can contribute to a TSP or a 401k. If you're not working, you cannot contribute to a 401k, TSP, IRA. You have to have wages. Right. Yeah, and then you can defer or put in after-tax Roth dollars as well.
I think we need to get into the whys here, why we need to pay attention to this, because to me right now, 75 seems far away, right? I'm not creeping up on 75. We joke about our age sometimes, but neither one of us is creeping up on 75. Why do I have to start thinking about this now, or why should I start thinking about it now?
Because I can look back and remember quite clearly when my boys were little.
I do too.
Yeah, you see? And that was 2 decades ago. Mark.
Yes.
Yeah, so when they were little pips, little toddlers, right? Mm-hmm. And there's that 6-year gap with Sophia and Jude, but I mean, that went by quick.
Yeah, it does.
And now, if you're in your 50s, I don't have to tell you how fast time seems to twinkle by when you just blink in your eyes. It's like, wait, it was winter? Wait, it's winter again? Wait, summer? Summer's gone? What? It's spring already? Yeah, it's just, everything's just zipping by. So if you don't start a plan,
mm-hmm.
you can and if you start a plan early enough, you can work that gradually, year after year. You can use time to your advantage, or time is going to wash over you like a wave at the ocean, or a set of waves, and you got hit by the first one and you come up for air and bam, the next one's there because you're in a set of waves. Hey, do I get to amp up some more?
Well, that's my question to you. So we'll start there. So how much, coming into the new year, coming into 2025, how much would be the first question we need to address?
So it's up $500. Is that right? 23.5. Mm-hmm. Yeah, that's right. It's up $500. But every dollar counts. So if you're at 23.5, and this is, let's say you turn 50 in 2025, even like December 31st, well, you can do catch up. Right. So you're off the table there. We're talking about those that are younger than age 50.
Right.
Okay. So 23,500 divided by how many pay periods?
There's 26 pay periods.
My man,
Yeah.
you're getting it. 26 pay periods. That's it. So what's it look like per line or per pay period? Looks like $904.
104. Okay.
Yeah. Now the exact amount of 23.5 divided by 26 is, I'm looking here, $903.85. So we go 904, and then the final 26 pay period. TSP will always reduce to make sure you're within the guidelines, so you don't get penalized. So it'll be $900 the last pay period, I believe.
Okay.
But you'll get your 23,500 in it. And by the way, for any 401k, those rules apply to TSP and all 401ks, 457, 403bs. It's 23,500 under age 50.
Okay. So now that you've mentioned ages, how does that change? Because pre-50, it's pretty straightforward. It's when you get past 50 that you start to get into the different changes based on age.
Yes. Yeah, that's right. Oh, well, so we get catch up.
Right.
Most Fed employees know that expression, catch up. And I think most folks that work for a company that offers a 401k retirement plan know catch up. So now that figure is at 7,500. Remember, it's the year you turn age 50, so you can back fund, right? If, like I said, if your birth date's in December, November, October, it doesn't matter. All the months prior to that, you can add catch up into it.
Okay.
So catch up there looks like 7,500. So we're talking $31,000 now.
Okay.
To be able to look at it logically and objectively. Yeah. And you were also floating around the idea of offering a large severance to the people that you're going to have removed.
Yeah.
Like a couple of years or something like that. Is that what you're saying?
Yeah, I mean, these are, again, just ideas, but I mean, it's the point is not that people suffer economic hardship. The point is just that there are more productive things they can do in the economy. And it would be better if they did these other more productive things. And we didn't have this vast federal bureaucracy. So I was like, maybe like a couple of years of pay would be good. And then they could take a vacation, they could take another job and get double pay. I mean, it's not going to create an economic crisis. I think it's actually going to be really good, I think.
Okay, so there is some insinuation that some of these jobs are not needed.
Right.
Right? So I'm not commenting on that.
Right.
Okay.
Because we have to remove, he says, he uses the expression more productive things. I think it implies something that he wasn't intending, which is to say that they're not productive now. I don't know that was what he meant per se.
Right.
But I think the main thrust of this message is about what you're about to get into.
Yeah,
right?
It's that he's saying, look, maybe we'll bring a severance package in.
Yeah.
Now, they didn't work the numbers up yet. I don't get the impression they did.
No.
And so let's see what they bring to the table. But if you are already intending to retire in the next couple years and you get a severance package for 12 to 18, 16 months of pay, then it might work out to your benefit.
Yeah.
And you might be semi-gleeful that this is happening because you're already planning on retiring.
Folks, we hope you enjoyed the recap of the videos, some of the highlights through this past year. We appreciate very much you being along with us for the ride right here at CD Financial. It's been great fun doing this. We hope it's been beneficial to you, and we look forward to 2025. We have a lot more content coming. We have a lot more things that we want to discuss. And again, thank you for being here with us, and we look forward to riding along in the future.
We're here for you. We'll see you soon. CD Financial, where health meets wealth.